Imagine having a roadmap to financial success, a time-tested guide that has helped thousands of investors navigate the ups and downs of the stock market. Welcome to The Intelligent Investor by Benjamin Graham, a book that has stood the test of time as one of the most influential works on investing. Warren Buffett himself called it the best book on investing ever written, and it has been shaping investors' minds since 1949. But here's the thing, Graham doesn't promise a shortcut to riches. Instead, he offers principles and strategies that focus on protecting yourself from substantial errors and teaching you how to make rational decisions. This isn't just a book about making money. It's about cultivating the right mindset to thrive in any financial climate. In AudiblePages, we'll break down Graham's most essential lessons. We'll cover strategies for building wealth while avoiding the common pitfalls that often lead to financial ruin. You'll walk away with practical insights and actionable advice that you can start using today. Let's dive into the world of intelligent investing. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. Graham begins by explaining the critical difference between investing and speculation. Investing is the practice of making informed decisions based on careful analysis, with the goal of achieving long-term returns. Speculation, on the other hand, is like gambling, high risk, driven by market whims, and typically focused on short-term gains. Consider this analogy. Investing is like building a sturdy house. You lay a solid foundation, add supportive structures, and ensure it's built to last. Speculation is like playing roulette. You're putting it all on black and hoping for the best. An intelligent investor seeks stability and security, while a speculator risks losing it all for a quick reward. Before you make an investment, ask yourself if it's based on thorough research or just a hunch. Shift your focus to assets that you believe in for the long haul, rather than those that seem like hot opportunities. A true investment is one that you're willing to hold on to and nurture over time, rather than a quick bet. Chapter 2. The Investor and Inflation. In this chapter, Graham discusses the silent impact of inflation on investments. Over time, inflation erodes the purchasing power of money, making it particularly detrimental to assets that don't appreciate, like bonds. This means that relying solely on fixed-income investments can put your wealth at risk. Imagine inflation as termites gnawing away at the foundations of your wealth. If you're not prepared, inflation will slowly diminish the value of your savings and investments. By focusing on growth assets like stocks and real estate, you can build a portfolio that stands up to inflation and preserves your purchasing power. Review your portfolio and ensure it includes assets that can outpace inflation. Diversify into stocks, real estate, or other growth-oriented assets. Keep in mind that while these may come with more volatility, they provide the best defense against inflation's gradual erosion of your wealth. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. Graham takes us through a century of stock market history to illustrate the cyclical nature of markets. He explains that the market experiences both booms and busts, and intelligent investors understand that these cycles are inevitable. By studying past trends, you can set realistic expectations and avoid overreacting to market changes. Think of the market like the seasons. You wouldn't be surprised to see winter follow autumn. Similarly, you shouldn't be shocked when a market downturn follows a period of growth. Recognizing these patterns helps you avoid the emotional roller coaster of reacting to every market swing. Next time the market experiences a downturn, remind yourself that it's a natural part of the cycle. Use historical data to set realistic expectations and maintain your composure. Remember, the best opportunities often arise in periods of market decline. Chapter 4. General Portfolio Policy. The Defensive Investor. Graham outlines the characteristics of the defensive investor, someone who prioritizes security and stability over high returns. He suggests that defensive investors maintain a balanced portfolio of stocks and bonds, adjusting their allocations based on market conditions. This approach minimizes risk and provides steady growth. Imagine you're hiking with a backpack filled with essential supplies. The defensive investor's portfolio is like that backpack, carefully packed to handle various conditions, ensuring you're prepared for whatever comes. By balancing between stocks and bonds, you avoid putting all your eggs in one basket and protect your investments from market volatility. Determine your ideal stock-to-bond ratio based on your risk tolerance. Start with a 50-50 split and adjust as needed, but always aim to diversify. This balanced approach provides a cushion against market downturns while still allowing for steady growth. Chapter 5. The Defensive Investor in Common Stocks. For defensive investors interested in stocks, Graham recommends selecting high-quality, dividend-paying companies with a history of stability. He advises against putting too much weight on any one stock or sector and emphasizes the importance of diversification. Think of stock selection like choosing ingredients for a recipe. You want fresh, reliable ingredients that add value, flavor, and balance to the dish. Similarly, a defensive investor looks for companies that are solid, reliable, and have consistently delivered value over time. Identify blue-chip stocks that have a history of paying dividends and have performed well in different market conditions. Diversify across sectors and industries to ensure your portfolio is resilient against sector-specific downturns. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. Graham discusses the enterprising investor, who is willing to take on more risk for higher returns. He cautions against speculative investments like hot growth stocks and IPOs, which may seem enticing but carry significant risk and volatility. Consider speculative investments like flashy fireworks. They burn brightly but often fade quickly, leaving you with nothing. An intelligent, enterprising investor avoids these and focuses instead on investments with strong fundamentals and long-term potential. Before investing in any growth stock or IPO, take time to research its fundamentals. Avoid putting large portions of your portfolio into speculative investments, and be wary of the hype surrounding new market trends. Stick with investments that have a track record of stability and growth. Chapter 7. Portfolio Policy for the Enterprising Investor. The positive side for enterprising investors. Graham provides strategies for seeking out undervalued stocks with growth potential. He emphasizes the importance of thorough research, disciplined buying, and avoiding emotional decisions. Think of this approach like antique hunting. You're looking for hidden gems that others have overlooked, carefully evaluating their value before buying. An enterprising investor doesn't just follow the crowd, but instead looks for quality stocks trading below their intrinsic value. Create a list of companies that meet Graham's value investing criteria, such as low debt, consistent earnings, and a strong industry position. Review these stocks regularly and only invest when they're priced below their intrinsic value. This strategy minimizes risk while maximizing potential returns. Chapter 8. The Investor in Market Fluctuations. One of the most famous concepts in the book is Mr. Market, a character who embodies the market's unpredictable behavior. Mr. Market offers to buy or sell shares daily at prices that reflect his fluctuating mood, sometimes overly optimistic, sometimes overly pessimistic. Graham teaches us to use Mr. Market's mood swings to our advantage by buying low and selling high. Think of Mr. Market as a friend who's prone to mood swings. Some days he's ecstatic, offering high prices, and other days he's down in the dumps, willing to sell for less. Intelligent investors don't let Mr. Market's moods dictate their choices. Instead, they wait for the right opportunities to act. Set a rule for yourself. Only buy when Mr. Market is pessimistic and prices are low, and consider selling when he's overly optimistic and prices are high. Avoid being swayed by market fluctuations, and instead, make decisions based on your own analysis of a stock's value. Chapter 9. Investing in investment funds. Graham evaluates mutual funds, emphasizing the importance of being cautious about high fees and underperformance. He advises choosing low-cost, well-diversified funds that align with your investment goals. Imagine hiring a tour guide for a trip. Some guides offer great value and lead you to incredible experiences, while others might overcharge and provide little insight. Graham encourages you to pick funds that align with your needs, are cost-effective, and have a good track record. Research mutual funds carefully, focusing on their fees, historical performance, and diversification. Consider index funds as a low-cost option that provides broad market exposure and can outperform many actively managed funds over time. Chapter 10. The Investor and Their Advisors. Graham stresses the importance of choosing a competent financial advisor who aligns with your goals and acts in your best interest. He advises against relying on advisors motivated by commissions, as they may prioritize their earnings over your financial health. Think of a financial advisor like a trusted coach. You want someone who provides guidance that helps you succeed, not someone who's simply pushing you towards products that earn them commissions. A good advisor will listen to your goals and work with you to develop a strategy that suits your needs. If you're considering hiring a financial advisor, ask about their fee structure, experience, and investment philosophy. Look for someone with a fiduciary duty, meaning they are legally obligated to act in your best interest. Chapter 11. Security Analysis for the Lay Investor. General approach. In this chapter, Graham provides a basic introduction to security analysis, which involves examining a company's financial health, earnings stability, and overall prospects. He offers a straightforward framework for evaluating stocks based on their intrinsic value. Think of security analysis as doing a background check. You wouldn't hire someone without first verifying their qualifications. Similarly, before investing in a company, you should understand its financial health, potential for growth, and competitive position. Get comfortable with reading financial statements and analyzing key metrics like earnings per share, price-to-earnings ratio, and debt-to-equity ratio. By practicing security analysis, you'll become more skilled at identifying companies with strong fundamentals. Chapter 12. Things to consider about per-share earnings. Graham warns against relying solely on per-share earnings, as this figure can be manipulated by companies to make their performance appear better than it is. He suggests evaluating per-share earnings within the context of other financial indicators. Think of per-share earnings as a single piece of a puzzle. It provides some insight, but by itself, it's incomplete. Intelligent investors look at per-share earnings alongside other factors, such as cash flow, debt levels, and revenue growth, to get a more accurate picture. When analyzing a stock, don't just focus on per-share earnings. Use additional metrics like return on equity and profit margin to gain a deeper understanding of the company's profitability and efficiency. This well-rounded approach helps you make more informed decisions. Chapter 13. A comparison of 4 listed companies. Graham presents case studies of 4 companies, demonstrating how to apply his principles to real-world examples. He analyzes each company's financial stability, valuation, and potential for growth, illustrating his approach to intelligent investing. Consider these case studies like practice drills. By studying different companies, you learn to apply Graham's principles to varied scenarios, improving your skills and confidence as an investor. Practice analyzing companies by reviewing their financials and evaluating their strengths and weaknesses. Use Graham's criteria as a guide to identify undervalued stocks and potential investments. This hands-on experience is invaluable for building your analytical skills. Chapter 14. Stock Selection for the Defensive Investor. For defensive investors, Graham outlines criteria for selecting stocks, such as financial stability, consistent earnings, and a history of dividend payments. He emphasizes the importance of quality over quantity. Think of stock selection like building a championship team. You want players who are reliable, perform consistently, and contribute to the team's overall success. The defensive investor focuses on stocks that provide steady returns and withstand economic fluctuations. Create a watch list of companies that meet Graham's defensive criteria and monitor them regularly. Look for opportunities to invest in these companies when they are trading at a fair price, ensuring your portfolio remains stable and resilient. Chapter 15. Stock Selection for the Enterprising Investor. Graham offers strategies for enterprising investors, such as looking for undervalued stocks with strong fundamentals. He advises a disciplined, patient approach to identifying growth opportunities. Imagine stock selection as a treasure hunt. The enterprising investor is always on the lookout for hidden gems, willing to put in the effort to find stocks that are temporarily undervalued but have solid potential for growth. Set criteria for stock selection, focusing on factors like low PE ratios, strong earnings growth, and manageable debt levels. Regularly research and review stocks that meet these criteria, adding them to your portfolio when they're undervalued. Chapter 16. Convertible Issues and Warrants. In the final chapter, Graham discusses convertible securities and warrants, which offer flexibility but come with added risk and complexity. He advises investors to understand these instruments thoroughly before including them in their portfolios. Think of convertibles and warrants as additional tools in a toolbox. They can be useful for specific purposes, but they're not essential for every situation. Graham encourages investors to only use these instruments when they fully understand their potential benefits and risks. If you're considering convertible securities or warrants, take the time to study their terms and implications. Make sure they align with your investment goals and risk tolerance before incorporating them into your portfolio. Practical advice and wrap-up. The Intelligent Investor provides a comprehensive roadmap for anyone looking to build a stable and successful investment portfolio. By understanding and applying these principles, you can become a more disciplined, informed, and confident investor. Take the time to reflect on each chapter and implement the practical takeaways that resonate with your financial goals. Remember, intelligent investing isn't about making quick gains. It's about building a solid foundation for long-term wealth and financial security.